Good morning, good afternoon, and good evening to all the participants who have joined us today from across the globe. I, Premji Fufal, welcome you all on behalf of Ashutosh Financial Services Private Limited for the ninth consecutive season of our NRI Financial Conclave 2025. We are truly grateful to all the non-resident Indians and their relatives joining us today for this exciting and informative session. Your presence and interest in the ever-evolving landscape of financial matters for NRIs is greatly appreciated. The topics and speaker for today's event are as follows: India 2025 and beyond, regulatory trend and investment opportunities by Mr. Nilesh Shah, who is the MD and CEO of Kotak Mahindra Asset Management Company Limited. Second topic is evolving framework of NRI taxation and financial laws by Mr. Daxesh Kothari, a renowned tax and financial consultant and the MD and CEO of Ashutosh Financial Services Private Limited. The third topic is emerging NRI investment opportunities by CA and CFP Mr. Rajit Kothari, the Executive Director of our company, who brings a wealth of expertise in NRI financial planning. And the last topic, expert panel discussion on GIFT City funds by GIFT City fund management professionals. Now, before we dive into the core presentation, we invite you all to watch the introductory video of today's esteemed speakers, Mr. Nilesh Shah, Mr. Daxesh Kothari, and CACFP Rajit Kothari. Following the presentation, we will open the floor for Q&A session, where you can share your questions in the comment section and we will address them. Please don't forget to provide your valuable feedback after this session through the link which will be available in the chat box. So without taking up more of your precious time, let's kickstart today's event and enjoy the enriching learning experience.
Mr. Nilesh Shah, Managing Director of Kotak Mahindra Asset Management Company, has spent more than 25 years in leadership roles across Axis Capital, ICICI Prudential Asset Management, Franklin Templeton, and ICICI Securities, working across investment banking and investment management in debt, equity, and real estate market for both Indian and global investors. Across all three mutual fund houses, he has been associated with Kotak Mutual Fund, ICICI Prudential Mutual Fund, and Franklin Templeton Mutual Fund. He has been part of teams that won the Best Fund House of the Year award. Mr. Shah is a gold medalist chartered accountant and a merit-ranked coast accountant. Currently, he serves on the board of Association of Mutual Fund in India and has contributed to regulatory consultations, including as a member of SEBI Corporate Bonds and Securitization Advisory Committee, supporting discussion on regulation, market development, and investor protection. He also served as a part-time member of Unique Identification Authority of India and is a member of Insurance Advisory Council set up by IRDAI. Mr. Shah also served as a part-time member of the Economic Advisory Council to the Prime Minister, bringing his perspective on financial market and economic policy to a national economic deliberations. He has written widely on Indian economy and markets and has co-authored the book A Direct Take on Financial Planning. A veteran of an Indian financial market, Mr. Shah is amongst the few leaders with a deep experience across all major asset classes, someone who has navigated multiple market cycles with clarity and who consistently prioritizes investor education. We are pleased to welcome Mr. Nilesh Shah to share his insight with all of us.
Mr. Daxesh Kothari is a tax and financial consultant and the Managing Director and CEO of Ashutosh Financial Services Private Limited which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He specializes in the fields of income tax, FEMA, trust laws, estate planning, and foreign tax compliances. On the financial front, he specializes in investment services and insurance services. He advises companies, trusts, high net worth individuals, and non-resident Indians across the globe on financial and tax and allied laws related matters. He is a trustee of various charitable trusts. He has been involved with a number of social service projects of Rotary Club and is a Paul Harris Fellow of Rotary International. He has been presenting analysis on the Union budget since last 16 years and also on various subjects of taxation and finance at various forums addressing doctors, businessmen, industrialists, taxation consultants, chartered accountants, company secretaries, NRI, and postgraduate students of diverse branches on subjects related to finance, taxation, and estate planning to make our society financially literate. His articles on financial subjects are regularly published in renowned newspapers like the Economic Times, Mint, etc., and also in magazines like Dalal Street. His interview was aired on ET Now as a mutual fund industry expert in the program named Swatantra, which is one of the most acclaimed investor education initiative of our country. He has also addressed a program dedicated to NRI on a leading Gujarati TV channel in Ahmedabad. He is a 360-degree versatile personality in the fields of taxation and finance, which makes him a unique and truly a one-stop solution provider for a wide range of financial and tax-related matters. Mr. Rajit Kothari is the Executive Director of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He is a chartered accountant and a certified financial planner by qualification. Further, he has graduated in the field of commerce with specialization in banking, financial services, and insurance sector from Ahmedabad University and has also pursued post-graduation in the field of law. He started his journey with Ashutosh Financial Services Private Limited, where he played an instrumental role in functioning of several business development activities of the company. He also played a vital responsibility in the development of exotic product offerings for the company in the alternate investment arena, such as foreign equity and unlisted stocks. Moreover, he was instrumental in the preparation of extensive knowledge database on different topics concerning taxation and finance for the company. Thereafter, he worked with Messrs. Deloitte Haskins and Sells LLP, one of the leading global consulting firms at Mumbai, focusing on tax and regulatory compliance for high net worth resident and non-resident individuals. He is an expressive public speaker and addresses professional forums on diverse topics related to finance as well as other topics of national importance. He has participated in international exchange program as a student and has also attended management development programs across top business schools in India. As a young and dynamic director with a multi-skilled personality, he presently concentrates on exploring innovative business opportunities through geographical expansion, digital proliferation, and concentric diversification of the company.
Greetings, ladies and gentlemen. A very warm welcome to all our esteemed NRIs joining us today from across the globe. Let me begin by expressing my appreciation to Ashutosh Financial Services Private Limited for organizing this 9th consecutive NRI Financial Conclave. Their commitment to promoting financial literacy among global Indians is truly commendable. Over the years, this platform has empowered thousands of NRIs to make informed financial decisions, and I'm happy to be a part of this journey. Our theme today is India 2025 and beyond, regulatory trends and investment opportunities. We'll explore how India's evolving regulatory landscape and economic trajectory are opening up new avenues for global Indians like yourselves. Let's start by taking a step back and looking at the global economic canvas. The world economy is at a crossroads. According to the IMF, global GDP growth is projected at 3.1% for 2025. Developed markets are grappling with persistent inflation. Just to give you a sense, the US Consumer Price Index is running at 3.2% year on year as of October 2025. Meanwhile, government debt in the US has crossed a staggering $38 trillion, with fiscal deficits exceeding 5% of GDP. What does this mean for investors? Well, global capital flows are shifting. In 2025, emerging markets are expected to attract $1.3 trillion in portfolio flows. Investors are reassessing their global asset allocation, and India is increasingly in the spotlight. Our share in global GDP is expected to rise from 7.8% to 9.2% by 2030. And over the next 5 years, India is projected to contribute nearly 20% of incremental global GDP growth. In short, while the world faces uncertainty, India is emerging as a beacon of stability and opportunity. Now, let's zoom in on India's stock market and its position in the global landscape. India's resilience has been remarkable. Over the past decade, the Nifty 50 index has delivered a compound annual growth rate of around 13%, outperforming many global peers. Even in the face of global volatility, India's markets have held steady, thanks in large part to robust domestic demand, prudent fiscal management, and a series of structural reforms. Yes, we've seen foreign institutional investors, or FIIs, pulling out over $16 billion year to date. But here's the silver lining. Domestic mutual fund SIP inflows have reached record highs, averaging 17,000 crore rupees, or about $2 billion every month. This is a testament to the growing maturity and resilience of India's retail investor base. Let's talk about what's driving this resilience. India's GDP growth for Q2 FY26 came in at a robust 8.2%, and the full year forecast has been upgraded to 7.3%. Per capita income has now crossed the $2,000 mark, fueling a surge in discretionary consumption. Corporate earnings are expected to rebound to double-digit growth in fiscal year 27. Which sectors are leading the charge? Banking and financial services are seeing sector consolidation and improving asset quality, with return on equity approaching 15%. The consumption sector is benefiting from policy measures that have added 1.4 to 1.5 percentage points to GDP. IT and pharma exporters are gaining from a competitive rupee and global demand. Healthcare and e-commerce are also emerging as structural growth drivers, with healthcare spending rising at a 12% CAGR. India's equity market is now trading at more reasonable valuations, setting the stage for the next phase of growth. Let's address a topic that's top of mind for many NRIs, the Indian rupee. The rupee has been on a structural depreciation path against major currencies like the US dollar, British pound, and Singapore dollar. Historically, the rupee has depreciated by about 2 to 3% annually against the dollar, in line with the real effective exchange rate model. As of December 2025, the rupee stands at 90.30 to the dollar, a new normal, if you will. Why is this happening? They are both structural and short-term factors at play. Structurally, India's inflation has been higher than that of our major trade partners, and our productivity growth has lagged. This inflation productivity differential naturally exerts downward pressure on the currency. India also runs the world's second largest trade deficit, with a $100+ billion deficit with China and $50+ billion with Russia. Much of this is structural, as we import essential goods like oil. In the short term, global risk aversion, portfolio outflows from emerging markets, and trade uncertainties have added pressure. But here's the key point. The Reserve Bank of India allows market forces to determine the rupee's level, intervening only to curb excessive volatility. This is not a crisis, but a managed adjustment that supports export competitiveness. For NRIs, a weaker rupee can actually enhance returns on remittances and investments. Of course, it also raises the cost of imported goods and overseas education, so it's a double-edged sword. Inflation, meanwhile, is projected at just 2% for fiscal year 26, at the lower end of the RBI's 2 to 6% target band. The repo rate stands at 5.25%, with room for further easing if needed. So, what does all this mean for your investment strategy? India's long-term investment case remains as compelling as ever. We are the world's fastest growing major economy, with GDP expected to grow at 7 to 8% annually through 2030. Corporate earnings are forecasted to grow at 10 to 15% CAGR over the next 3 years. Our market capitalization has crossed $4 trillion, placing us among the top 5 globally. For NRIs, the opportunities are vast. Indian equities, with over 10,000 listed companies and 40+ asset management companies, the breadth and depth of the market are unmatched. Mutual funds, systematic investment plans or SIPs, have grown to over 2.5 lakh crore rupees, about $30 billion annually. This disciplined approach to investing has proven resilient, even during periods of FI outflows and market volatility. Gifticity, India's international financial services center, now hosts over 100 international funds and banking units, offering tax efficiency, global product access, and seamless repatriation. India should be a core allocation in your global portfolio. Not only does it offer growth and diversification, but it also provides a hedge against global uncertainties. To sum up, the world is facing challenges, but India stands out as a beacon of opportunity. The rupee's depreciation is a structural adjustment, not a crisis, and supports our export competitiveness. Disciplined investing, sector rotation, and a focus on fundamentals will be key to capturing India's growth potential. NRIs like you are uniquely positioned to benefit from India's rise. So, stay engaged, leverage professional advice, and make India a central part of your long-term wealth strategy. Thank you for your attention, and I wish you all the best in your financial journey. Let's make the most of India's decade together.
Thank you, Mr. Shah. And now we request Mr. Daxesh Kothari to take his part of presentation.
Hello, everybody. After those valuable words from Mr. Nilesh Shah addressing the non-resident Indians, it makes great sense taking a meaningful exposure insofar as investing in India is concerned. The moment somebody looks at a meaningful exposure in any jurisdiction, any economy, the first and foremost thing which one must look at is that what is the situation in respect of its tax and financial laws, because that would form the basis for anybody to understand how will this journey be in the times to come. And the first thing which one has to look at is in respect of the banking regulations. When it comes to the banking regulations, a non-resident Indian in India is not allowed to keep resident Indian accounts. We have come across to several situations where somebody who was in India and has now moved outside of India, but they continue to holding resident Indian accounts. So all these resident Indian accounts should be converted to NRO accounts or it should be closed. The non-resident Indians have a variety of accounts which has got different features. The first account being the non-resident ordinary account. The non-resident ordinary account is a non-repatriable account, by which what I would mean is that the funds which are credited or which are lying as the balance in this account cannot be repatriated or moved outside of India, and that would remain very much in India. So when anybody has got an non-resident account, that is an account where credits and debits of non-repatriable funds would take place. As I said, the existing resident Indian accounts can be redesignated or converted into an NRO account. Insofar as taxability of this account is concerned, the interest in respect of this account is taxable, and it will lead to a withholding tax or a TDS on a regular basis on the interest which is received. The another account which a non-resident can open is a non-resident external account. The balances in this account would arise from remittances from outside of India or from transfers from other NRE account or an FCNR account. The balances in respect of this account are freely repatriable. By that, what I would mean is that the balances in this account can be transferred outside of India without any restriction whatsoever. And the interest in respect of this account is completely tax-free and exempted from income tax and TDS or the withholding tax insofar as India is concerned. The third type of account, or rather a deposit account, which a non-resident can hold, is an FCNR account, which is a foreign currency non-resident deposit account. So this would not be a savings bank account, but it would be a deposit account. And the interesting feature of this account is that this account would be very much in India, in the Indian banks, but the balances in respect of this account can be held in different foreign currencies of choice. And the interest which would be paid in respect of these deposits would vary depending upon the currency in which this deposit is placed. The balances of this account can be transferred from the NRE account, which is a repatriable account, and vice versa. The interest in respect of this account, which is a foreign currency account, is completely tax-free insofar as India is concerned, and there would be no TDS or withholding tax on this deposit. The feature of this account is that, as I said, that the deposits would remain in foreign currency, and the advantage which a non-resident can take is that they can borrow Indian rupees against this deposit and have a shield against the depreciation of the Indian rupee, because the deposit remains in the foreign currency and the borrowing happens in Indian rupees, and the Indian rupees are then invested in India. So this can be a mechanism by which one can have a shield against the depreciation or the likely depreciation of the Indian rupee in the times to come. The another type of account, which is the recent development in the recent times, is a gift city bank account. A gift city, we will hear in detail as to what exactly the gift city would offer in terms of the advantages which it offers on the taxation and the regulatory side. But just as a matter of understanding, a non-resident Indian, or for that matter, anybody who is a resident outside of India, may be or may not be a person who is a person of Indian origin or OCI card holder, or even non-individual entities can open savings account and term deposit account in the gift city jurisdiction. These accounts have to be necessarily in foreign currency and not in Indian rupees. The saving bank account could carry an interest of 2.5% to 5.5%, depending upon the bank and the terms of that bank. And the term deposit or a fixed deposit account would offer a return which is basically higher than the standard global rates which are offered on the term deposits. The interest in respect of this account is also completely tax-free in India, and there is no TDS. Obviously, this funds can be moved from outside of India to India in the gift city and vice versa, freely and seamlessly. The inward cost in respect of this account is basically nil. The outward remittances, depending upon the quantum of the money which are transferred outside of India and the banking relationship, but that is also something which is quite limited. The most advantageous feature of this account is that a non-resident, not necessarily a non-resident Indian, or as I said, an entity can also open a gift city account, can park their savings or investments in a term deposit or a saving bank account, which is geographically in India, but with basically no regulatory restrictions and taxation. So this is an important addition to the kind of accounts with the non-resident Indians have all these years. The another important aspect for all the non-residents is that, as I said in my earlier part of the presentation, that the balances in the non-resident ordinary account cannot be repatriated outside of India. But on the face of it, yes, it cannot be repatriated outside of India, but there is a very substantial amount of leeway and concession which has been given by the Reserve Bank of India, and remittance from the non-resident ordinary account, which is as such a non-repatriable account, to the extent of $1 million per person per year, can be transferred to the NRE account or straight away from the NRO account to outside of India. Requirements in respect of this transfer is that taxes due in respect of the funds which are contemplated to be transferred have to be paid. A simple CS certification procedure has to be carried out, but one needs to be mindful that these should not be any funds which are from borrowed sources. And if somebody intends transfer an amount which is in excess of $1 million, then in that case, a specific approval can be taken from the Reserve Bank of India, and a larger amount beyond $1 million can also be repatriated outside of India. As I said, this is 1 million US dollar per person and per year. In respect of India, the year starts from 1st of April and ends on 31st of March. So come next 1st of April, once again, a non-resident can take the advantage of repatriation of another 1 million US dollar. And that is per person. So if it is a family of more than one individuals holding investments in India in an NRO account, then a substantial amount of money can be repatriated outside of India very seamlessly. This concession is very helpful in case where there is a sale of owned real estate in India or inherited real estate in India, any gifts which are received in India from relatives, then if there is a loan which has been granted to some relative in India or to anybody in India and those loans are refunded, then those monies can also be transferred outside of India. Then investments, if they are made in some businesses, when they are returned, they would get credited to the NRO account. But under this scheme, they can be repatriated outside of India. And last but not the least, investments which have been made from the NRO account or erstwhile resident Indian accounts. So somebody was a resident in India, and in those times there have been investments which have been made by that individual in India in different stocks, mutual funds, then those monies on redemption would get credited to the NRO account, but under this scheme can be very much repatriated outside of India. So the scope of repatriation on account of this scheme becomes very large and very meaningful for the non-resident Indians. Another advantageous or an interesting and noteworthy feature which has been added to the mutual fund investors, and there are a lot of mutual fund investors insofar as non-residents are concerned, and this is a very welcome move which has happened in the recent times. And that move is that transfer of mutual fund units is now possible. In earlier times, what was prevalent was that mutual fund units which were held in the statement of account were not allowed to be transferred, nor the holding pattern was allowed to be changed. And if in case one wanted to do any kind of activity of transferring, then it would lead to a scenario where it has to be a redemption which will attract tax liability and then reinvestment in another name. So it was something which led to an incidence of tax and discomfort to mutual fund investors. Under the new flexible norms which have been now instituted is that transfer of these units can happen to a relative, one. In that case, it leads to a very advantageous tax planning which is possible, whereby somebody in the family who is holding mutual fund units has got income which is liable to tax, then it can very well transfer these units to a relative. And that relative, if has got limited incomes and not incomes which are liable to tax, then effectively one would lead to a tax saving by this kind of planning, which is absolutely legitimate. Then these units can also be transferred to third parties. So the advantage which somebody can take is that if under a succession plan or under a will, one would say nominate somebody as a nominee in respect of the mutual fund investments, and the nominee receives the entire money on the death of the unit holder, then it can very well transfer these amounts seamlessly to third parties who are the ultimate beneficiaries under the will. And this can happen very seamlessly now, and this would not lead to any tax implications to the nominee who is the basic recipient or the person who is going to get those units on death of the deceased. So these kinds of very interesting, useful plannings can be done on the basis of this flexibility which have been available. Unit holders can be added. So if a husband and wife are the holders, one of them unfortunately passes away, then the son or daughter of the deceased can be added, or for that matter, anybody can be added as a holder in respect of the existing investments without any difficulty. Interchanging of the holders can also be done. So in case of marriage, in earlier, before marriage, say son and father were the joint holders. After marriage, son and wife can be joint holders. In case of divorce, if husband and wife are holding, one can decide who is going to own those units. In case of family separations, if two brothers were holding, one of the brothers can be moved off and wife of the holder can be added to it. So many kinds of advantages and a lot of flexibility and a lot of planning is possible in this scenario where transfer of units of mutual funds is possible. Aadhaar card for NRIs. This is a subject which comes up for a lot of discussion and questioning to us. A non-resident Indian who is an Indian passport holder, irrespective of the fact whether he is staying in India or not, can always avail an Aadhaar card in India. A foreign passport holder can avail Aadhaar card in India only in a scenario where in last 12 months he or she has been in India for 182 days. Otherwise, that person does not become eligible to an Aadhaar card in India. In case somebody has availed any Aadhaar card in India by whatever, say that person was a resident in India in earlier times, then he became a non-resident, or for that matter, in any scenario, one has an Aadhaar card, and then that Aadhaar card needs to be linked to the PAN card, and that is compulsory. But if as a non-resident Indian, I am not eligible to get an Aadhaar card, then I need not link it with my PAN card. And it is not mandatory or a requirement for a non-resident Indian to have an Aadhaar card. In fact, in so many of the circumstances or so many situations, a non-resident might not be eligible even get an Aadhaar card. So for a non-resident Indian, having an Aadhaar card is optional in certain situations, but not mandatory definitely. OCI card and a non-resident Indian. This is also a topic which comes up for discussion. And the position of law is that for investing in any financial assets in India, either one should have an OCI card or one should be eligible to obtain an OCI card. And that part, that eligibility or registration of an OCI card is definitely mandatory. Now let us look at the taxation of Indian incomes for non-resident individuals. Principle is, and this is something which is very important and all non-resident Indians should understand it very clearly, that any income which accrues, arises or is received in India is always liable to taxation in India. And yes, the income is liable to taxation in India, but then is somebody required to file tax returns on these incomes? Then the answer to that is that one would be required to file tax returns in India only in a scenario where they have an income which is chargeable to tax in India and it crosses the minimum threshold of 4 lakhs of rupees, or one wants to claim a refund, or one wants to claim a carry forward of losses, or as has been narrated out here, different situations where somebody has done meaningful transactions of financial transactions in India. Only in that scenario, one would be liable to file tax returns in India. Now, let us look at what are the benefits which a non-resident Indian can avail under the double taxation avoidance agreement. India has signed double taxation avoidance agreements with all the major jurisdictions in the world. The first advantage one can take under the DTAA is in respect of concessional rates of taxation in India. And the countries which the non-residents of the countries which can benefit out of it are Kenya, Singapore, UAE, Saudi Arabia, Malaysia, and Germany. Under this, the advantage one can have is that as the principle under the DTAA goes, that whatever is the position under the Indian Income Tax Act and whatever has been laid down under the DTAA in respect of the terms and the rates of taxes, the non-resident Indian has the right to choose and opt for whatever is beneficial, either what has been provided under the Income Tax Act in India or under the DTAA. Somebody is a non-resident, they can lawfully choose whatever is beneficial to them. So now, in respect of these countries, where there is a concessional rate of tax which is being provided under the DTAA, there are concessional rates of tax in respect of sale of equity-oriented or debt-oriented mutual funds. And the most interesting part is that under the DTAA with these countries, the taxation of mutual funds for all those countries which I narrated is completely zero. It is zero tax. And if somebody was taxed under the resident Indian regime or the regime which has been provided under the Indian Income Tax Act, then there are rates of taxes as it has been mentioned. So all those tax residents of the countries which I mentioned can definitely take advantage of these zero rates of tax or concessional rates of tax in respect of dividends and interest. In case where somebody is the tax resident of those countries which are mentioned, which is a benefit of that concessional rate of tax, all that they need to do is that at the time of sale of the mutual funds, as I said, that the gains in respect of mutual funds, whatever be the quantum in respect of tax residents of these countries is completely tax-free. There would be a TDS which would happen, but one need to take TRC, a tax residency certificate from the country of residence where that non-residents belong to. Thereafter, they need to fill up the form 10F and the TRC certificate along with it at the time of filing of the tax returns. The moment this process is done, then the entire amount of TDS which has been deducted in respect of the sale of any kind of Indian mutual funds would get refunded and one would end up with a zero tax. Then another benefit or relief which is still available is that the income tax credit or relief which is available to the residents of countries like UK, USA, Australia, and Canada. Here the relief is that whatever are the incomes which are accruing, arising, and are received by the non-resident in India are offered to tax in India. So India would levy taxes on it under residence rule that because this income has accrued and arisen in India, we will tax it. But at the time of filing of the returns for that investor who is in the US, Australia, Canada, they need to pay taxes on the global income. When they pay taxes in the global income in their country of residence, what it would lead is that it would lead to basically double taxation because USA, Australia, Canada is also going to levy tax. And that income has already been taxed in India. But under the DTAA, whatever are the taxes which have been levied by India at the time when those incomes are sourced from India, those taxes under the DTAA, one would get a complete set off of it. Only the additional amount of tax that might be required would be paid by the non-resident, and the taxes which have been paid in India will be available as a benefit under the DTAA. Now, after making all these investments and taking a substantial financial exposure in India, one definitely needs to understand that what happens to the Indian assets in case of death of a non-resident Indian, and how would the laws of succession operate in India. When anybody dies in India, and if that person is a person domiciled outside of India, there could be two scenarios which would happen. The first is that that person dies after executing a will, and that is called a testamentary succession. Under a testamentary succession, whatever has been provided by the deceased in the will, respect of movable and immovable properties or assets, the assets would pass and would be bequeathed in accordance with whatever has been mentioned in the will. If in case somebody dies without executing a valid will, which is an intestate succession, then the different laws in India would apply in respect of different castes to which that individual belongs to. In case of Hindus, the Hindu Succession Act would apply, and whatever has been provided in respect of who would be the beneficiaries under the Hindu Succession Act would be the persons who would be the beneficiaries to whom these assets would get bequeathed. That would be in respect of the immovable assets. In case of movable assets, the succession would happen in accordance with the law of succession of the country for which the non-resident is domiciled. Now, as I said, that the Hindu Succession Act would apply. So, under the Hindu Succession Act, the Hindu male will have defined class 1 heirs, and a Hindu female have a defined set of class 1 heirs, as has been mentioned. And if in case, if there are more than one legal heirs of this level or this class, then his assets would be distributed equally amongst all these legal heirs. As I said, that a person domiciled outside of India would be the matter of consideration which one needs to look at the time of deciding as to which and what kind of laws of succession would apply. So, by that, what I would mean is that the first and foremost way of determining which is the domicile of the person who is deceased would originate from the fact that where that person was born. So anybody who is born in a particular jurisdiction, the first and foremost factor of determining which domicile is the place where that person is born. But then somebody elects a domicile by choice, whereby he or she expresses an intention to stay permanently outside of the place where that person is born, then both this residence and intent would change the domicile of the person. So somebody who is born in India, in the first place, is an Indian domicile. But when they move outside of India and they demonstrate an intention of residing in India and permanently residing outside of India, then that intent would change the domicile of the person. And this is the determining thing insofar as the laws of applicability of the laws of succession is concerned. Another clarification which one would definitely should look at and one needs to have is a nomination enough for appropriate succession of financial assets of NRIs in India? The answer to this is that nominee is merely a custodian and the assets would be transferred by the financial institution in favor of the nominee. But nominee is not the final owner of the asset. The final owner or the real owner of the asset is the person who is the beneficiary under the laws of succession. In case of testamentary succession, whosoever is the beneficiary under the will. And in case of an intestate succession, whosoever are the beneficiaries under the respective laws of succession. And obviously, one would feel that it makes great sense executing a will in respect of Indian assets. Well, one need not be physically present in India to execute a will in respect of the Indian assets. A will can be very well prepared outside of India and it can be signed by the testator. And we always advise our clients that if it is signed for the notary public, wherein the testator and the two witnesses, as is required under the Indian laws of making a valid will, if they sign before a notary public, that is an ideal situation, and declarations of the witnesses, both the witnesses, that they have been a part of this execution of this will suffice for anybody to create a valid will in India and a proper process of succession insofar as Indian assets are concerned. This brings end to my part of the presentation on the taxation and financial laws which are applicable or which are important, which I thought would add value to the non-resident Indians.
Thank you, Mr. Daxesh Kothari. Now let's jump into the exciting topic, which is related to the emerging NRI investment opportunities, which is going to be addressed by Mr. Rajit Kothari. Thank you.
Hello, everyone. It's always exciting year on year to address all of you from different parts of the world on this topic of NRI financial landscape. Moving forward to the second part of today's presentation, which is investment opportunities. Firstly, let us first understand as to what is the rationale behind participating in today's Indian economy. We had a very pertinent address by the eminent stock market speaker, Mr. Nilesh Shah, earlier today. Now, let us deep down have a complete analysis of the present Indian investment landscape, starting with the most widely accepted means of investing today in India, which is equity mutual funds. Right now, the entire India has accepted that mutual funds are the way to go about, with the Indian mutual fund industry crossing a landmark figure of 70 lakh crore rupees. We come across several mutual fund portfolios, but the ideal mutual fund portfolio that needs to be constructed, which we advise everyone, is basis these three fundamental parameters, which is number one, the financial profile, meaning the incomes, assets, borrowings, future liabilities of an individual, risk appetite, meaning the kind of volatility or the fluctuations in the value of the investment that the investor is willing to accept, and ultimately for what is the investment being done? What are the investment goals? SIP or systematic investment plan is a very effective and a tool which the entire India is investing, with the total SIP flows crossing staggering 29,000 crore rupees every month. A mutual fund comprises of all these categories that we have mentioned in the slide. and an appropriate distribution across all these categories is very important. Not just that, but a concentration into different mutual fund companies is important, along with several important parameters. This is a sample key performance indicator parameter that we use to evaluate and select any mutual fund scheme using several different types of parameters that are enlightened, not just the past returns, but the comparison with the benchmark, which is BSE 500 in this case. Sensex, Nifty are the most popular benchmark indices that we know of, but every category has got a different benchmark. And comparing it with that respective one is very important. Along with that, several financial ratios, bifurcation between large, mid, small, all these factors are very critical to select a mutual fund scheme. Once the investment is done, reviewing the portfolio on a regular basis in a systematic manner is equally important so that the portfolio is agile and we capture all the opportunities with the changing economic landscape. Not only that, but also there are several funds which might not do well, which might not perform. So exiting from that at the timely level and the timely in the timely manner is also very important. The second avenue of participating in the equity market is through portfolio management service. Now, a PMS is basically a bunch of diversified equity shares in a separate earmark or a demat account in the Indian context. The way we have got different mutual fund schemes, there are different strategies that a PMS runs, and a selection of those strategies can be done within a PMS that is selected. The minimum ticket size of a PMS being 50 lakhs of rupees can be split into different strategies depending upon the financial profile of the investor. We often come across this question as to how is it different than a mutual fund. Comparing it to a mutual fund, there are three basic differentiators over and above the basic structure, wherein there are equity shares which are owned, which are basically invested. Is number one, this is a concentrated portfolio, meaning the number of shares that are owned in the name of the investor, as I mentioned, in a separate demat account, are quite less, which could be 20 to 40, depending upon the PMS, as compared to a mutual fund which has got 50 to 100 stocks in the underlying portfolio and even greater than that at times. So a concentrated portfolio always delivers better returns with the passage of time as the markets move forward. That is what the history has shown. The second difference is that regulated restrictions which are there for a fund management team in case of a PMS are much lesser than a mutual fund. Give a few examples. The PMS, in a case of a mutual fund, the fund cannot own more than 10% in a single stock. Similarly, there are sector-specific ones. In case of a PMS, there are no such restrictions. So the fund management team has got a better legroom to play the third differentiator is that if there are inflows and outflows in case of a mutual fund of other investors, then it impacts the entire portfolio because it is a common pool of funds. And in case of a PMS, as there is a separate demat account which holds the shares in the ownership and name of the investor, inflows and outflows of other investors does not impact the portfolio. Similarly, just as we had a look at the KPI of mutual funds, this is a KPI evaluation tool that we use to select the PMS scheme and decide as to what could be the right strategy to go about for any investor. This is several parameters that we have mentioned, which is the top stock holdings, sectors, performance, so on and so forth. Moving beyond the listed space of equity markets comes the unlisted space. Now, firstly, what is the rationale or the objective of investing into unlisted space? The answer to that is very simple. Catch them young. Take advantage of being the early mover investor. And because what happens is that whenever these companies tap the capital markets and go for something called as the initial public offering, the IPO, there's a huge demand, not just from the retail investors, but also from the institutional investors, which takes the price of the stock the next level and leads to something called as a multi-bagger growth, which is 2x, 4x, so on and so forth. And when this company goes for this IPO, then it is very obvious that the story is visible to the world at large, and thereafter, choose to generate that extra mile return may not be there as much as what is there in the unlisted space. Whenever we discuss this opportunity of the unlisted space investment with several investors, the two common challenges that they always come across, which act as a hindrance to invest in unlisted companies, is number one, identifying companies, which unlisted companies to invest in. There are so many companies, and the public information and the information of these companies not even available in public at many times. So to identify the company is a major challenge. And second, the valuation. At what price should we invest in these companies? Because many of these companies are even loss-making companies. They are companies which are still not their business model is such that which might take a very long time to generate profits. So the answer to that is by investing in a professionally managed alternative investment fund, and that to category two, which invests into unlisted stocks. There are other AIFs which are through in the GIFT City route, which we will discuss later, which are in the category three ones. But this is category two AIF, which has got highly experienced fund managers across the industry who have got deep expertise of identifying these companies, and not just identify companies but also the valuations at which someone should invest into these companies. So it is a very structured manner of investing into unlisted stocks, with the minimum investment size being 1 crore, which is investable or payable in different tranches spanning across a time of 1.5 to 2 years, and the entire cycle of investing and return on the investment just exits normally through the IPOs takes about 5 to 7 years. Moving even further beyond the shores of India comes global investing, investing into the mother market of the world, which is the US market. And to facilitate that, we have developed our own platform, which invests into US stocks and ETFs through a broking partner in US. The funds can be remitted from any part of the world directly to US, and there is no taxation to or capital gains to persons who are not tax residents of the US, meaning persons who are not living in the US, maybe in any part of the world, they do not have to pay any incidence of taxation. Also, there are several attractive opportunities which are available to invest in the global markets beyond US. This is the snapshot of that investing platform, which is used by investors to invest in the US market as well as the global markets. These are certain portfolios, sample portfolios that we have curated for investors who can invest in the US stock market, starting with the Magnificent Seven, the most popular companies that are there in the US, and several other theme-based portfolios, AI, which we all know of, space tech, cybersecurity, deglobalization, meaning companies which are going to benefit with this trend of protectionism, meaning the deglobalization. Since the domestic companies are given a lot of benefits over and above the companies which are not from US. All the companies who are going to benefit from this kind of phenomenon are going to benefit out of this. There are similar such portfolios that we mentioned. As I mentioned, this platform also gives opportunity to explore the global markets. The Chinese market, which is considered to be very attractively valued at this point of time, and has also delivered an attractive return in the last 6 to 12 months. Someone can also take exposure into the Chinese stock markets through ETFs, which are there in this platform, which invests in the US market. Certain practical insights that I wanted to share for every NRI to navigate in today's times, which are all common issues that we often face. A fundamental question that we receive from so many of the NRIs across all the geographies is, should we invest in Indian real estate? How lucrative is it to start investing in the real estate space. Now, it might sound to be very appealing to invest in the real estate space with the kind of infrastructure development that is happening all over the country. But there are several challenges which an investor must keep in mind before participating in the Indian real estate. Number one is the liquidity and management. Selling any real estate property within the desired time and within the desired price is a major challenge for all properties across the country. Secondly, the entire process of investing, disinvesting, selling, liquidating, then paying taxes on it, thereafter repatriating funds to the home jurisdiction wherever the NRI is located, is all possible within the four corners of the Indian law, but it requires a lot of time and efforts which might turn out to be very tedious. The next generation of most of the NRIs who are there in at least the developed markets are not willing to relocate to India structurally. Forget about relocating, they're not even willing to visit India frequently. So, passing over this portfolio of real estate properties to them in inheritance may not be a good idea. Unless someone is planning to self use the real estate property, it may be a good idea. Otherwise, financial assets are a much better means of investing in today's times, brings a lot of convenience, liquidity, as well as growth and appreciation vis-a-vis real estate. Currency, which is the hot topic right now, and a lot of people that we come across are often concerned about the appreciation of the Indian rupee vis-a-vis the US dollar that has happened sharply in the last 1 year. Even though we all know that the last 1 year has been not so good in terms of the currency depreciation, by currency depreciating to the extent of 5 to 6%. But if we look at a 10-year horizon, which is the ideal time, 5 to 10 years, when someone is planning their investment journey in India, then if we annualize that, meaning as to what has been the depreciation on a year-on-year basis, it comes out to 3% compounded annual kind of a depreciation that has been experienced. So it might sound that the depreciation has been quite steep, but if you look at a very long-term perspective, then it has been 3%, which is the figure that we need to keep in mind. Understanding as to why does the currency depreciation happen and why is it happening, especially in the present time, then it is on account of the global reset, the global changing dynamics of several different countries, which is playing an important vital role, which was also understood in the first part of today's presentation by Mr. Nilesh. And as such, the fundamentals of Indian economy are quite sound and stable. And it is not that the depreciation is happening on account of the weakening of the Indian economy or its fundamentals. It is on account of some global changes which are beyond the control of India. And as such, by rule of economics, depreciation happens on account of two reasons. One is the inflows and outflows of the funds into and out of India. If we look at the present context, and the foreign fund flows in India are quite robust, with several infrastructure manufacturing projects coming up, and are likely to even improve further on. And secondly is the inflation differential between the two economies. And if we look at even the second aspect, then the differential between the inflation of India and that of many developed economies that we know of, including US, is within the band of 2%, which is considered to be very healthy compared to the past trend, which clearly shows that as such, the parameters are quite positive for currency to depreciate, to see some kind of a movement in the near future. Interesting analysis that we need to look at is that if we compare the total size of the Indian economy, meaning the total GDP, the sum total of everyone's income in simple words in 2008, which was $1 trillion US, with the present one, which is $4 trillion, then across the span of these 17 years, the economy size has quadrupled, meaning multiplied or grown by 4 times. And if we compare the oil imports, as we know, our country is heavily dependent upon oil imports, as we are not producers of oil to that extent. And the oil import has increased by only 80%. It has not even doubled in this entire span of 17 years, while the economy has been 4 times. Why is this important? It's because the energy landscape of India is evolving. It clearly proves that. And the reason why the currency depreciates is because of the trade deficit, meaning we imports are not compensated by the exports. And that is why the currency gets hit. If we look and compare the size of the economy vis-a-vis the kind of the import burden that Indian economy is facing, and it is quite positive and is a clear-cut signal that the impact on exchange rate is going to be steady in the coming times. Retirement planning is something which is very close to the hearts of several NRIs that we come across. And so many of them have got dreams to spend their retirement phase in India. Even if they do not want to spend the retirement phase in India, even then they want to build a retirement corpus in India. Now, we help several NRIs prepare a very structured retirement plan, which has got the entire planning divided into 2 phases. The first is the accumulation phase, while the NRI is active in the professional life and is earning and building onto the corpus. And second is after the retirement. And the person starts withdrawing the funds and utilizing that corpus. And it is important to go for a goal-based planning because there are several moving parts, several important factors which needs to be considered by preparing a financial plan for retirement, which is number one, currency, because as we know, there is a depreciation of currency. So the purchasing power in dollar terms might be affected with the changing currency equation. Second is inflation. Naturally, even though the inflation might be lower in developed economies as compared to India, it is still there, and across a long time, it is very important to take that into consideration. And number three is taxation. We might see the kind of growth that is coming in, but what is the post-tax kind of a ultimate corpus that we are going to create is what ultimately matters. And systematic investing across all these categories, not just equity, which is definitely fundamental, but also fixed income, alternates, which could be commodities or even unlisted stocks, is also something which need to be considered in preparing this financial plan, along with the timeline. The withdrawals would depend upon the tax implication and the lifestyle needs of each investor. Still, a sample retirement plan which we prepare for our investors, which starts with a goal statement. In this case, it is to withdraw 2 lakhs of Indian rupees every month when the investor attains the age of 55 from the kind of portfolio that is created. And we have broken the entire planning into different parts to take into consideration the inflation as well as the currency aspect. So I will not go into the details of each part, but to sum up, considering the entire goal-based planning, an investor will require this kind of a figure in a systematic investment plan. At present, to reach this stage is what considered the entire idea of this goal-based investment plan. The second is a guaranteed income plan, which is also becoming increasingly popular in India, which ensures a steady, fixed, tax-free income. The idea of this kind of a plan is that there is a certain guaranteed income which the investor can attain, come what may, even if there is some kind, whatever happens to the stock market or the Indian economy, or even the interest rates that are prevailing in the economy. We all know that the RBI has been consistently reducing the rates, and that will definitely reduce the kind of interest rates which the banks offer. But this kind of a plan ensures that a certain income at a predetermined rate is always available across tenures, which could be as long as 30 to 40 years. What happens is that there is an annual premium, which is 5 lakhs, which we have taken as an example in this case, because beyond 5 lakhs of investment annually, the plan becomes taxable. And there is a continuous inflow of funds, incomes that starts from the very next month once the investment is done, along with a death benefit, which is also tax free, which is 10 times that of the premium paid, which starts and continues for long tenures. Hypothetically, we have assumed that someone can invest these incomes into systematic investment plans into mutual funds. So on one side, there is steady flow of income, and on the other side, it is invested into mutual funds, which can appreciate. This can go on for as long as 40 years, as I mentioned. So at the end of 40 years, if someone consistently earns income, that too assured guarantee, irrespective of any external factors, then this is the kind of corpus of about 18 crore rupees that can be gathered by investing just 5 lakhs of rupees for 10 years. This is the magic of compounding, and this is how the guaranteed income framework works, which is very popular in India. So to summarize the entire guaranteed retirement planning, it can happen through both ways, through equity options, wherein there are systematic withdrawal plans, the way we have got systematic investment plans, which work from equity mutual funds. There's tax efficiency from these plans. There is certain tax breaks, tax exemptions on long-term capital gains that are available to every investor. So considering that, effective liability on SWPs from mutual funds turns out to be very less or zero in many cases. The balance corpus, which is not withdrawn, keeps growing with the passage of time. There is flexibility, meaning the amounts can be increased or decreased with time, depending upon the requirement of the investor. And second is through fixed income, through the guaranteed income plans that I mentioned, or even through pension plans, which are for very long tenures, as long as 30 to 40 years. The kind of returns that are offered also very attractive, considering the rates of fixed income, which are prevailing in the market right now, meaning whatever is the fixed income rate, earning rate right now on deposits, something around that is something that can be expected from these plans. And there is flexibility, as I mentioned, on increasing, decreasing the amount. Moving to the interesting part of the final interesting part, rather, of today's presentation, which I'm sure all of you would have heard at some or the other point of time through news articles or hearsay or through WhatsApp, some messages, is about GIFT City. And what are the opportunities that the NRI has through GIFT City? Now, first, let us understand before going into GIFT City funds as to what is the GIFT City all about. GIFT City is the first international financial center in India, in Gujarat, one of its kind. And the vision of the government is to make it like any other global financial center, like Singapore, Dubai, Hong Kong. The entire region that we have marked in the slide in the presentation is a special economic zone to promote financial services. So geographically, this is very much a part of India and Gujarat, between the cities of Ahmedabad and Gandhinagar. But as such, it is an area outside of India from the exchange control point, from the FAMA law perspective. And the benefits are only in the financial services sector. And there are several income tax benefits that non-resident investors can avail if they are investing through the GIFT City funds in the Indian markets. Otherwise, all other laws are applicable in this area. Now, this is how, to summarize, any NRI can take benefit of the GIFT City framework. There is any person who could be a foreign national, OCI card holder, or even if someone does not have OCI, it could be an entity outside of India, meaning a corporate, trust, any other firm. They can invest into AIF, Alternative Investment Fund, of category 3 in the GIFT City. AIF is basically a funnel kind of a structure, meaning a fund of fund kind of an arrangement. It simply pools the money and invests into Indian mutual funds, which are all known and which all of us have been investing since a very long time. So the idea is to accumulate funds, pool funds, and invest further into mutual funds. Idea behind doing that is that there is no income tax implication in India, meaning all the capital gains arising to the fund as well as to the investor from the entire transaction is completely tax-free to the investor. Since there is no income tax, there is no requirement of even obtaining a PAN or filing tax returns in India. Naturally, tax assessments do not come if there is no income tax. There is also a requirement of opening a brokerage account in India or a demat account or even a bank account. The funds would flow directly from outside India to that of the account of the fund and back. All the investments are denominated in USD, which makes the conversion very competitive. And the onboarding process is also very simplified to facilitate. So how the entire flow works, to summarize, wherein the investment is done in AIFs that are registered in the GIFT city. The AIFs would invest in the individual funds, which invest in the equity shares, and the entire gain arising out of this is completely tax-free to the investor as well as the fund. The funds can be repatriated back seamlessly. The advantages, as I mentioned, is there is no tax implication in India, no requirement of a demat account, bank account, US denominated, basic KYC. This is the entire framework of all different types of funds that are available in the GIFT City framework today. Of late, a retail fund is also available in GIFT City, which can invest or accept investments with just $500. And there are also global funds which invest into stocks and markets outside of India, which can start with $5,000. India equity funds have been quite active, and there are a lot of them which basically invest in the Indian stock market now to the extent of 150,000 US dollars. The global equity funds are also there, which invest into global stocks or a bunch of global ETFs and stocks at $150,000. Hybrid mutual funds also are available, and debt-based global funds, which invest into debt securities outside of India, also available. It's utmost important to understand as to which fund is suitable to the financial profile of that investor and select the fund accordingly. We have a thorough research-based KPI that we prepare. In the sense, all the data parameters that depending upon the country of origin, the underlying investment, the kind of growth, the expense, are all factors which we consider and recommend the GIFT City Fund because it is a very vast kind of a opportunity, vast kind of a offering that are there with so many of the funds coming in. What is our expertise into GIFT City? Number one, we have got office presence in GIFT City itself, and we have a thorough data-driven analysis of all the funds that are in the GIFT City ecosystem at present, which helps us give a very thoughtful kind of a recommendation on the fund, which covers all the funds practically that are available today. And it's not just about recommendation for fund and tracking that, about investment aspects, of course, and also the advisory from the viewpoint of the exchange control regulation, FAMA, and taxation is also something which is what we provide. Case by case analysis is something which is very important, as I mentioned, because it all depends on the country of origin as to whether the fund will accept that the investment. Also, naturally, the financial profile risk appetite is important, and there are different criteria on exit, meaning different conditions that need to be fulfilled to take an exit from these funds, which is also very important, which we also keep in mind while recommending a GIFT City fund. And we have a very strong expertise in this. And we have onboarded several investors from practically now all the countries that you can think of into the GIFT City fund across the globe. A final message from our Honorable Prime Minister, which emphasizes on the kind of landscape change that we have seen, that we have witnessed in the last 11 years so far. And we did not see anything but the numbers, the entire length and breadth of the country. Even if you being outside of India visit India, can definitely witness, and that is a entire path-breaking kind of a change which has happened on every front in India and has changed and brought India to a new dimension altogether. A general disclaimer that all the views were personal, and wherever we have used any kind of data, you mentioned the source. We've been organizing these kinds of international events across the globe since last 2 years, and in fact, we have organized multiple events at few places, and we have received a very encouraging response from probably thousands of individuals that we would have met across all these places that we have traveled in multiple cities in all these countries. And we will continue doing so even further to empower Indian diaspora globally. Uh, brings us to the ninth consecutive NRI Financial Conclave. And we have tried to change and revise whatever is something that is a newer opportunity for NRIs year on year so that everyone is updated with the latest happenings and opportunities that are available. The repeat session of this would be at 10 p.m. IST. If any one of you wants to join again or share this with your friends and relatives, you're most welcome. And we have got physical events at Ahmedabad and Rajkot later this month. If you can make it, we would be very happy to see you in person. And the entire recording of this session will be shared with you by way of a YouTube link on the number through which you have registered today itself, or latest by next week, so that you can view this presentation again. A brief about us as to what we do before we move to the panel discussion. We have a legacy of more than 65 years being a one-stop solution provider. So the idea is to have a one-stop for every other kind of financial planning need that someone might think of, with a team strength of more than 60 persons across different financial domains, having active office presence across the cities of Ahmedabad, Rajkot, Gift City, and Mumbai, managing more than 1,200 crore rupees of assets, which is close to 135 million US dollars, predominantly in India and also in the global financial markets, serving more than 5,000 clients across 26 plus countries. The services that we provide to NRIs, to break them into details, is number one, investments in India of all types into mutual funds, PMS, AIFs, alternates, as well as global investing through the platform that we have developed. Gift City Solutions, as I mentioned, through in all the funds possibly that are available in the Gift City ecosystem, which invests in India as well as the global markets. We provide end-to-end thorough advisory, Indian income tax compliances, meaning filing of Indian income tax returns, to handling tax assessments, and every other thing that might be required. Also in terms of taxation advisory. Estate planning is basically preparation of wills in India, planning for the succession of the assets, and also private family trusts, wherever there is a need to do so, and a good case and advantage of doing so. We are insurance brokers, so we work with practically all major life insurance companies of India to provide life insurance solutions. International tax compliance is also something very important, because India has got a treaty or a double taxation avoidance agreement with major nations of the world, as we understood in the earlier part of today's presentation. So we help in understanding as to what are the benefits that are available of this treaty and how can someone take actual advantage of this by supporting in this entire process. Advisory for financial regulations, meaning repatriation funds, or funds planning for any other kind of financial transactions that you can think of. And coordinating with the bank is also something which we support, because banking, as we know, is the tip to any kind of financial activity in India. The advantages for anyone who is working with us is that there is a single point of contact for anything and everything that they can think as far as the Indian financial affairs are concerned. In other words, we are like a family office for any NRI who is there in any part of the world. This is all possible through our team of specialists in different domains of finance. And this brings a lot of convenience, not just to us in terms of discharging the services, but also to the person who is working with us, because it's a holistic kind of advisory that we provide, and also eases the compliances once the entire information is available to us. So far as our charging mechanism is concerned, all these ancillary services that I mentioned, the taxation, the compliances, the advisory, is all complimentary from our side. We do not charge for that as long as the investment portfolios are managed by us. If any one of you happens to visit any of these locations, it would be a pleasure to meet you in person and interact with you to help you navigate in your financial journey. Now, let us move forward to the panel discussion. We have got esteemed panelists with us who will guide us on the GIFT City opportunity. I'll briefly introduce each one of them. We have firstly with us Mr. Abhinav Sharma from Tata Asset Management, who is a IIT IIM graduate and has got a vast experience of nearly 2 decades in the equity investing landscape, working with several renowned asset management companies. Mr. Manas Kumar is the head of the business development and products at HDFC, AMC, and similarly, he is also IIT IIM graduate with similar kind of experience of 2 decades in this entire investing journey, and he's also at a very senior position and has been one of the first AMC's first persons to be active in the GIFT City framework. And the third panelist that we have is Mr. Abhin Shah, who is from ICICI Prudential Asset Management Company, who is an MBA and a CFA charter holder, and similarly has got vast experience in the entire financial analysis and portfolio management industry. And he's basically the fund manager at the ICICI AMC. So all three of them will guide us with the entire ecosystem of GIFT City investing. And let us now move on to that part.
Yes, thank you, Mr. Rajit Kothari. Now, let's start the panel discussion with the GIFT City exports from HDFC, ICICI, and Tata. Thank you.
Okay, so a very warm welcome to all three panelists. We know that all three of you have got funds, excellent funds, which are there in the GIFT City. And they invest basically into the underlying mutual funds. And it is very interesting that all the three funds that are there from all three different asset management companies are different in their own investing style, absolutely unique. It will be very interesting to understand each one of them, and it will be a very different kind of exposure to any investor who is attending today, so that the person can get a complete perspective on basically all kinds of funds that are available today in the GIFT City ecosystem.
A warm welcome to all the three esteemed guests who have taken out time on this weekend and accepted our invitation to be a part of this panel discussion. So as Rajit said that, basically in order to make any alternative investment fund tax-free, then the underlying investment, as we all know, has to be Indian mutual funds. But all the three funds which are managed by all the three asset managers are, in our understanding, a little different in the way their underlying portfolios are. So my first question would be to Mr. Abhin Shah, that Mr. Shah, what is the mandate of the investment in respect of the ICICI's AIF, which has now been launched in the GIFT City? So what are the underlying investments which would be made in respect of the investments? I would like to request you to throw some light on that.
Yeah, thank you. Thanks. So very good afternoon to everyone and all the esteemed guests and the hosts. It's good to connect with you all. So yes, as no, it was mentioned that predominantly all the funds that are live from Gift City at this point of time are investing into mutual funds. Ours fund, which is a ICICI Prudential Smart Navigator fund, is also investing into mutual funds. But what we are going to do is that we would not be deploying the entire sum into just one fund. Rather, we will be creating a portfolio of 7 to 10 funds, and then we'll be adding a flavor of active management within those funds. So no, it helps an investor in a way that they don't have to sit no into just one fund, and depending upon the macros and the views of the fund house, the internal allocation amongst the different funds would change. And over here, we will be, within the ICICI funds, we'll be creating a core portfolio of themes and sectors. So that is what we want to do. That we believe that by identifying the right sector or a right theme, we can generate that additional alpha, which will be able to compensate on the INR depreciation that an investor has to bear with. So yeah, that's the broadly strategy on how no we'll be positioning our fund.
Okay. And how often you will make these changes? So it would be at some periodicity, or is there something where there would be certain preset parameters on the basis of that you would be making these changes?
So as such, it's completely based on the views of our fund house. Like if any sector plays out within, let's say 6 to 8 months, then we might be comfortable of moving out of that particular sector fund, because here we have a comfort of, no, there is an exemption on the mutual funds churn. So no, the capital gains on the mutual fund on the churn is exempted at the gift city level. So if certain calls are tactical, then we'll be taking in as per that. So we'll be following an internal framework of VCTS. That's an internal framework which no comprises of valuation, cycle, triggers, and sentiments. So it's not a predefined no frequency that we will be looking at, but yes, it will be done on an ongoing basis, and the active management would be done on a more regular basis, I would say.
Okay, so it sounds interesting because then in one investment, one would have a flavor of a portfolio as such, rather than
Correct,
investing into a particular kind of an option. Very good.
correct, correct.
Now I think we'll move to Mr. Manas Kumar from HDFC Asset Management Company. Mr. Manas, what is the kind of mandate that we follow in respect of the AIF, which has been launched, or rather those few AIS which have been launched in the gifts, because NBFC has got quite a few interesting bouquet. So if you can throw some light on it, please.
Yeah, sure. So Daxesh, first of all, an excellent piece which you stated earlier, following on with Nilesh Bhai's piece, and Rajat, good to get. I mean, you've covered a fair bit of what maybe the three of us could do on gift cities. I'll maybe just congratulate you on that before I move on to talking about what HDFC MC has done. So in our case, the primary premise when we began about a year and a half back was that why reinvent the wheel? We had a set of funds which, to a large extent, a lot of investors were aware of. These are funds which have $8, $9, $10 billion in size. Some of them have a 30, 31-year track record. These are funds which have seen multiple investment cycles. And they have so these are funds which a lot of investors, especially NRIs, as well as a certain set of institutional investors overseas, relate to. So to that extent, Gift City would have been a dollar access solution with regards to the same set of operational tax enablement nature category of investor benefits, which Rajat just mentioned. And we would try to make it as easy and transparent with regards to global investors investing through Gift City into those funds. So that was the whole premise when we started about late last year. So we ended up with 5 funds. 3 of them were launched initially. We had FlexiCap, mid-cap, and Balance Advantage. We thereafter, earlier this year, have also added small cap and a feeder onto a Nifty 50 ETF. So what that provides to investors is, and if I maybe just quickly cover the 5 strategies, which most people are aware of, but FlexiCap is more of an all-cap strategy. It's usually the entry-level strategy for a lot of people looking at India exposure. It has a large cap bias, but it does provide two. One, a fairly active alpha, even though it might be large cap biased. And it does give you that flavor into small and mid cap as well, where the PM could obviously decide allocations based on his or her view on where it should be. Mid cap in India is a peculiar spot in terms of a universe of 150 stocks. These are leaders of tomorrow, but it does come in with a slightly more limited universe and the momentum driven largely because of the nature of how that segment in India is defined. The third is obviously small cap, which where the index values and performances could be very different from what a bottom-up portfolio construction could do. And therefore, small cap is where there could be a lot of opportunity for alpha to be generated and for some of these multi-bagger ideas to be played out. So these three are the active equity funds that we looked at. Balance Advantage has traditionally been a product for people who are looking at equity but do not want to go largely into the fixed income space, right? And it has a long period of existence, and that does add comfort to people who are looking at equity with some amount of conservatism. Nifty 50 was a product required, one, for a significant segment of institutional investors who were looking at India, and also for a certain category of investors who wanted a large cap passive exposure. So that was the whole premise on how these 5 funds started. And maybe I'll just add on to what Abhin was saying a little earlier. We too are now looking at perhaps a product which would perhaps be a basket of funds, which should come out in due course. But we initially started in going ahead that, so if you look at the names of our fund, the GIFT fund is called HDFC India Flexi Cap Fund, which feeds into the HDFC Flexi Cap Fund. So the whole name association relating to a dollar investment to an underlying fund was what we were looking at that point.
Yeah. So Manasji, your funds make our life very easy and simple to communicate with the prospective investors. So we have to just say that it is the Flexi Cap Fund, and you've got a long track record. Earlier, you used to come through the NRO NRE route, investing into this very fund, and now you have got a tax and regulatory arbitrage where you can come through the GIFT City route and you are basically investing in the same thing. So that makes our life very simple, and there is a track record and everything which is available. So definitely these kinds of funds also make very good sense for us. Yeah, true.
Thank you.
Yeah. So now coming to Mr. Abhinavji, you have created, Tata Asset Management has created something which is like, earlier, the biggest bottleneck for all of us was that 150,000 USD. And you have created that retail kind of an opportunity, which has completely changed the way people have started looking at the GIFT City solutions. So it's a very, very interesting and a welcome way of, approaching the GIFT City, which is now open not just for high net worth individuals, but for everybody. So please enlighten us on the kind of offering which the Tata Asset Management Company has on the GIFT City AIF front.
Sure. Thank you, Daxesh bhai. So absolutely our pleasure to participate and speak to you and your clients. To just stepping back and telling you why we waited and launched a retail fund only. And so when we looked at the ecosystem, it was only non-retail funds. By non-retail funds, those are the AIF category. So India has a 1 crore minimum. GIFT City had $150,000 minimum. We started taking feedback from partners like you, and what we understood was that 150,000 is about 1 crore 32 lakhs, give or take. At these market valuation, people who had money also did not want to deploy those kind of in a single shot or 4 installments. We said we will wait it out. We worked with the regulator very closely because we are one of the first retail inbound funds that we launched. So happy to say that we are, you can say that Tata is the first retail inbound fund. We wanted to break the myth that this is a HNI, GIFT City is only for HNIs. So we said we want a client across his life cycle, somebody who started saving, somebody who started working, even somebody close to retirement can come into a retail fund. So there is a minimum that we've set at $500, which is about 45,000 rupees. But there's no maximum. So we can take $1 million also if somebody trusts Tata to manage the product. Now, when we were thinking about the product, we looked at the ecosystem again. Then there were single scheme feeders. There were There was a Mirai product, which was something what Abhin said, that multi-scheme feeders. When we started taking feedback, we understood that the NRI doesn't have time to reallocate. Secondly, unfortunately, right now, Gift City funds, you cannot switch from one scheme to another scheme. You have to redeem, take the money back, and get the money back. So we were more comfortable in a retail fund, which is a basket of funds. Now, the strength of Tata is one, the brand, and second, that we call ourselves a full service provider. So we have the full basket of funds. We have all funds in the diversified and the market cap based SEBI categories, and we have the largest book of sectoral and thematic products. So we named our product the Tata India Dynamic Equity Fund. It has two components to it: 70% core, which is the main SEBI categories, market cap based and diversified, and 30% satellite, where we have one of the largest books of sectoral and thematic products. So, like Abhin said, our product is a product which will take active calls in the main categories and do tactical calls in sectoral and thematic as well. You had asked Abhin about the rebalancing period. It is a completely Tata Market Outlook product. So there is no rebalancing. The advantage of a fund of fund, retail fund, and a non-retail fund as well is that there's no underlying tax. We can change tomorrow. So if we think GST 2.0 will benefit our consumption fund, we can go into consumption. If the market's correct, we can go into our mid cap momentum product to capture momentum. So it's a very simple product, 70-30, 70 core, 30 satellite, a mix of active and index. And if the client will trust Tata, we will make a product which is like the CD100 marketing campaign, a fill it, shut it, forget it product.
So very, very nice. So this is also an approach wherein with just $500, one can have a portfolio as such.
Gee.
So that's quite interesting. So Mr. Abhin Shah, so what could be the new products which would be there in the offering, which you have on your drawing board as of now?
Yeah. Another product that we are planning to launch is an outbound fund, which will give you exposure into multi countries ETFs in a I mean underline, and another would be a retail inbound fund. So these are the two products that we are planning to launch. Retail inbound, maybe just like just to like get the benefit of the legacy of ICICI, cause similar to what Manas mentioned, like HDFC, FlexiCap. So we also have certain like flagship funds. So we will have just an feeder funds to them, so that those who want to take benefit of certain ideas, like a value or a blue large cap fund. So one of them would be a part of it. But what we are more interested is on the outbound space. We want the NRIs and the resident Indians to utilize the limit of LRS and get exposure into the outbound funds that we can provide our advisory into. So yeah, these are the two set of funds that we are planning to come up with in the near future.
Okay. Interesting. So we'll wait for those funds, and larger the bouquet, it gives us a better legroom to offer to our clients. That's interesting. Yeah. Manasji?
So on the inbound side, we're looking at, as I mentioned, a diversified FOF across equity strategies. So there'll be an inbound MF fund of fund feeder, or fund of fund rather than a single dedicated feeder. So that's something we're working on, should be happening shortly. On the outbound side, we've been working on a couple of products. One of them will potentially be a more diversified basket of strategies on global equity. And so we would look at perhaps providing access to domestic investors to the best of breed strategies which are available globally from a global or international equity. So those are two, and there's another one on the outbound which you're working on. Those are the strategies we'd look at. So yeah, mix of continuing with what you've done on the inbound and adding an suite of outbound products to it as well.
If I'm not mistaken, Manasi, you have secured your filed Form 8832 for the funds, HDFC funds in the US. Am I right about that?
That's right. So for our inbound funds, the gift asset manager has done the relevant filings with SEC, the ADV filings, and the funds are available for what's called exempt offering to US persons on a private placement basis. And related to that, from an IRS perspective, on the taxation side, we've done the partnership election for those funds with IRS, and we do provide a K1 tax certificate, pro forma K1 tax certificate to US investors for their ease of taxation, getting that tax burden lower when they invest into our gift funds.
So that's very interesting and a very welcome move. This opens obviously a lot of opportunities for investors from the US here. Interesting. Abhinavji, now you already have that retail offering, which is quite interesting. So now what is the next set of planning which you have in respect of the Gift City?
A lot of plans. So we've just come back from our strategy meet, and we clearly everybody in the ecosystem understand, even in the Tata Group understand that gift is a very scalable opportunity. So I will break it down into two parts. So I will say inbound, what are our plans, and outbound separately, because inbound is more for the audience right now. So we have launched this retail fund. Second product, we will try and launch a fixed income product, which would look to hedge some kind of return so that we could give dollar returns, which are kind of FMP kind of returns. So we will do that second. We will do a single scheme wrapper fund once we take feedback from partners like you on which is our best fund to market to your clients. So we will do that. And then we will also look at a long short product because there is a big audience which looks at not taking so much risk, but they want a fixed income plus kind of return. So that is for the on the inbound side. On the outbound side, the first basic product will come in the retail category, which will be a global allocator product. Then we will look at a theme which we are very confident that will deliver. So a single scheme ETF like AI, something emerging market, maybe rare earth. That we are also looking at global absolute return fund. So in the next 3 years, you will see about 6 to 8 launches from our side.
Interesting. Quite interesting. Okay, now what we'll do is that we'll open the house for questions relating to the Gift City, obviously, because we are fortunate to have a panel of very eminent speakers who are absolutely involved in the Gift City ecosystem, and we are fortunate to have them. And any other questions in respect of the earlier part of the presentation, which is the tax and regulatory and the other investment part. So we'll open the house for any questions.
Yes, so it seems like that the most of the audience are much interested for the Gift City investment opportunities that we have, and we start taking up some of the questions that we already have in the chat box. So the first one is by Mr. Parth Amipara, who is asking that can a Gift City bank account be used by a resident Indian or NRI to send monies overseas without having any TCS obligations?
So the Gift City ecosystem presently has got bank accounts which are there for non-residents, basically. So persons who are non-residents may be of Indian origin or not of Indian origin can open their bank accounts with the Gift City banks. And for them, as such, there is no TCS that is applicable. Even if there is an NRI who is transferring funds through the NRE account, and TCS is not applicable. So either ways, through the Gift City or through the mainland India banking, TCS is not applicable to NRIs. As far as the resident Indians are concerned, presently TCS is applicable to them. Even if they move funds to the Gift City outbound funds, then even that is considered as LRS because Gift City is like a part which is outside of India. from the FEMA perspective. So whenever funds are going into any GIFT City funds, then TCS will be applicable because it is LRS and it has to be within that confinement of 250,000 USD dollars.
Right. Another one in the chat box, which is by a participant named as KD, and is asking for the returns that we can see from the GIFT City investments. Are those returns are being monitored under the USD term, or it is going to be the same as we get to see from the INR based mutual funds?
Right. So the returns will be denominated in USD naturally because the investments are going to be denominated in USD. But in terms of percentages, it would be similar to what we can expect in the Indian mutual funds because the underlying funds are the Indian mutual funds and that too in the direct plan of the Indian mutual funds. So it would be somewhere which is something which is similar that someone can invest at and expect the regular plan of Indian mutual funds.
Okay. Another one by Mr. Vinay in the chat box, and he has raised a concern with regards to sending the monies to the GIFT City investments vehicles. Now, he is asking for if there is any option which is available that the GIFT City investment account, the AMCs can request the monies to be received from their foreign bank account. I believe their foreign bank accounts are not allowing them to send the funds to the GIFT City investments because might be it is a new opportunity for the investors.
You want me to take the answer? I can answer that.
Sure, please.
A very good noting. I think you've already invested or tried to invest into a GIFT City fund. The problem right now is a very basic problem that there are about 35 banks. 35 banks which are opening NRI accounts also. There are banks which are opening LRS accounts for resident Indians, and there are bank accounts opened for AMCs. Now, unfortunately, what is happening that GIFT City, there is a system problem wherein suppose a UAE customer is choosing GIFT City, he has to choose India, and then IFSC comes as a mandatory field. Now, IFSC is not, GIFT City IFSC codes are not updated with the global banking systems. There are some banks which have updated, there are some banks which have not updated. We've raised it with the regulator and the banking IBUs. Banks are called IBUs in GIFT City, and what we understand, there is a circular which will come in the next 15-20 days, which will help ease this discomfort that you're facing right now in terms of doing online transfers into GIFT City bank accounts. It will go away in the next 15-20 days. So everybody will have their own solution, but the problem which you're facing right now will go away in the next 15-20 days.
Okay, thank you. Another one by Mr. Vinay, and he's asking that if he has the FCNR deposit, which is linked to the NRE account, so that FCNR deposit directly can get transferred to the GIFT City investment AIF, or it is supposed to be converted to the monies are supposed to be received in the NRE, and then he can remit to the GIFT City account.
So again, I will take this. So I am not too sure about FCNR. We can come back to you in the next couple of days. But see, basically the idea of GIFT City is that you do not get the money onshore. You don't get the money in India. You put money from your bank accounts. But there were a lot of NRIs when we took feedback saying that we have a lot of money already in India, which we want to use. I think out of the $135 billion remittances that come in, about 60% goes into bank accounts and FCNR. So we took an internal approval. We went to the regulator and we said, NRE accounts, you can remit USD. FCNR, I'm not 100% sure if Manish and Abhin know about this, they can add. But I will take time, but I will come back to you on FCNR. NREs, NRE account, you can remit USD into my GIFT City account.
Right. Okay, now let's move on to some other questions which are not related to GIFT City. So one question is...
What we'll do is that we'll take a couple of questions.
Sure.
And then in respect of some questions which I see that they are a little longish in nature, we'll reach out them one-to-one. Definitely, it will be our pleasure. And that's the reason why we organize all these things to reach out to the non-resident Indians. But We will take a couple of questions in this common platform.
Sure. So we'll just take two questions now. And one is with regards to the whether one is having investments into Indian mutual funds, so that whether the units can get transferred from the investor's account to any of their relatives, maybe a daughter or a son. Is it possible?
Yes, it is very much possible. Now, under the new regime, the investments can be transferred from to a relative by the holder or to a third party. The only thing is that if it is a relative, then in that case, it would say if it is transferred without, obviously, again, without a consideration, then it will tantamount to a gift, and gift to a relative as defined under Section 56(2) of the Income Tax Act. In respect of all those relatives, it is completely tax-free. If it is transferred to a third party, then it has got implications under the Income Tax Act. And if the first holder remains the same, and if you want to add or delete or change the joint holders, then it will not have any tax-related implications, and all these things can be done now under the new facility which is available, which is the flexibility of transfer of units, which are in the statement of account.
Thank you. Thank you. I will take the last question, which is by Mr. KD, and he's asking that which is with regards to the estate planning. So the question is that, do we need a separate will for assets we have in Australia and a separate will for the assets we have in India, or a combined will serve the purpose?
So a will which is a valid will under the Indian Succession Act is something which can work for both India as well as Australia if it has the essentials of a valid will. It's required under the Indian Succession Act. But our advice to all of our clients is that it's always better to prepare separate wills for separate jurisdictions, so that one need not be the other jurisdiction need not get a little complicated. Things don't get complicated, and one will for one jurisdiction is an ideal way of doing it.
Right. So shall we proceed with the ending remarks?
So a special thanks to everybody who has joined, all the people who have non-resident Indians who have joined from different corners of the world and participated in this NRI Financial Conclave Season 9. Special thanks to them, and a big thank you to all the three esteemed speakers on the GIFT City front. Once again, I would acknowledge the fact that it being a weekend, you made it a point and allocated time for this conclave. So nice of you. A special thanks. Special thanks to Mr. Nilesh Shah for addressing this event. And thank you very much. So that it gives us an encouragement to go for these kinds of conclaves year on year. Thank you so much. Thanks to everybody.
Thank you, everyone. Looking forward to the next.
Thank you. Thank you.